Hey guys, it's Eddie Speed, founder of Note School. Now the video you're going to watch is over an hour long. Why is it worth it? Why does it matter? Why do you care? Right? Here's what we did. We're very fortunate. The executive team in our company has $3 billion plus in experience in the note industry and the loan origination industry and the real estate investing industry over the past 4 decades, right? A lot of experience, tons of experience. And so these guys constantly pay attention to what's being said and what market data is telling them. And in other words, we're trying to guide the ship, and we want to make sure we have all the weather report. We know the condition of the water and the weather report and what's on the horizon. We don't want to be surprised that a hurricane is on top of us and we didn't know about it. Now, you've heard me refer to this as a crash in slow motion. So the guys I want to introduce you to is Bob Repass. Now, Bob Repass, I've sold loans to him for years and years and years. We're talking about a couple of decades. I sold loans to him for years when he was an executive at the Associates, and he was later the top executive in charge of the seller finance division of Bayview. And so Bob had a ton of experience, couple of $1 billion worth of loans under his management under any given day that were private loans. So he clearly has a ton of experience, and he's very good at this, very articulate, and you'll see this in this video. It's a commitment, but this commitment is going to give you a direction and understanding and show you some things to watch for as this market COVID condition progresses. Next guy is Kevin Moore. So Kevin Moore, I did business with for years, and he lent money on probably 16,000 rental houses, and then was involved in the discount note space as well as being a very, very active real estate investor. So you'll see that, and there's a good camaraderie back and forth, but these guys are going to give you a market condition that says, here's what's happening. Whether you know it or you don't know it, here's what's happening, and more importantly, they're giving you some things to look for to see what happens exactly when the market changes. Everybody's trying to guess about this. We know there's a crash coming. Like anybody that thinks there's not any crash coming, it doesn't line up with the data. But we're trying to give you clear signs of the biggest opportunity and stuff out there and what the timing of it is. Watch this. I think you're going to love it. This is a state of the industry. Bob Repass, Kevin Moore.
Okay, guys, we're going to talk a little bit about what's going on in the industry. Kevin Moore and I have put together some information here, and we are going to look at 3 particular things. So I'm going to update you guys on the latest on the stimulus package as far as what's been going on since the passage of the last CARES Act, and most of that expiring, and what we could foresee happening between now and Election Day on that. And we're going to talk about the state of the residential housing market, and then we're going to talk about the state of the commercial real estate market. And we're going to drill down pretty deep on a lot of these things, but we're going to kick off with a little bit on the stimulus package, and we're going to look at the current forbearance numbers, the latest news. And when I say latest news, I mean like I got it within the last 10 minutes on foreclosure and eviction moratoriums. We're going to take a look at what happens with the unemployment assistance now that the federal enhancement ran out on July 31st, and what may or may not be taking place to help some of the middle and low income borrowers, homeowners, and citizens out there. We're going to look at how that might have an impact on bankruptcies and what the trends look like over the first 6 months of the year on personal bankruptcies as well as business bankruptcies. And then I want to also talk a little bit about what I focus on as far as what indicators do we look at to see when the consumers are making it, they have the confidence to get back out and spend money in the economy. So that's what we're going to talk about in our first session. So Kevin, you with us?
Bob, I am here. How are you doing?
We're doing good. And Kevin and I have done a couple presentations together in the past, so I tend to go fast and he tends not to land the plane, so we're going to try to balance each other off here and keep this thing going nice and smooth and get going there. So Kevin, what I wanted to cover first was it has now been 9 weeks in a row that the forbearance plans have dropped. As a matter of fact, this is the second week in a row that they dropped by 23 basis points. So the overall forbearance plans are down to 7.2%. Still 3.6 million loans in forbearance, which is high. But I think, Kevin, I think this is a little misleading. And that is because although Ginnie Mae has dropped 52 basis points down to 9.54% of their portfolio are in forbearance, there's a reason why, and that is because buyouts of the delinquent loans from the Ginnie pool. So somebody like Wells who has loans in there, they just rather buy them back than to make the servicing advances. So, and that's impacting the numbers. Obviously, your percentage goes down when you buy loans out of there. So what do you think the impact of that is, and what is the logic behind somebody doing that?
Well, and Bob, to your point, so right now, if we looked at this, there's a lot of people that are spinning this and they're going, listen, the forbearance numbers are being reduced, and even though there's smoke, there is no fire. You and I are both, we've been around long enough, we know that that isn't true, because the real truth is, number one, a lot of the lenders are basically taking the loans back, where they're like, listen, it's cheaper just to take them back right now, hold them on our book, and it's a way to puff up the numbers. The second thing is, there are some people that did get a second round of checks, and so they did send a payment in. This really, in my mind, is more of a, hey, we're kicking the can down the road. And I don't look at this as being optimistic news. I look at it as being kind of fake news.
Well, it's interesting. When the CARES Act first came out, it was like, okay, and again, just so everybody's clear, when we refer to the mortgage forbearance plans for the CARES Act, those are on government-sponsored loans, Fannie, Freddie. Ginnie Mae is FHA, VA, loans like that. So that's what we're referring to. We're not referring to a typical, private mortgage or something that we may own in our own portfolio. So we're talking about Fannie, Freddie, conventional type mortgages, which obviously makes up the largest percent of the mortgage industry. But all you had to do was call your servicer, request a forbearance plan. There was no real qualifying, and you got an automatic 3-month forbearance that you could extend till 6-month period. And just to kind of give you an idea on that, I'm going to go to my next slide here and show you guys that the percentage of borrowers that are extending their forbearance. Now, to Kevin's point, some people are still making their payments even though they're inside the forbearance plan. But it's over 50% of the people that are in forbearance are now requesting to stay in the forbearance for an additional 3 months. So that's also having an impact, because once they're in there, even though if they make a payment this month, if something happens to them, their income, or they have some situation, some hardship next month, they can miss a payment and still be under the forbearance plan. So the impact on that, Kevin, may be skewing the numbers some as well.
Well, and Bob, when you compare your first slide to this slide, I look at the second slide, which is the percentage of borrowers extending. I look at this as being a more important slide to follow, because this is giving us a snapshot, kind of looking at people's kitchen tables, where they're going, okay, what should we do? What should we do? And they're choosing to extend. And the reason they're doing that, in my opinion, is because of the uncertainty that the COVID situation and just overall economic situation has created for people. And they're afraid that, if they get back in and start making their payments, that 3, 4, 5, 6 months down the road, they may have another economic event where they're not going to be able to make their house payments again, and they aren't going to be able to go back into another forbearance probably.
Yeah, and I want to show you how that kind of impacts, because there's a lot of people, even though they could get a forbearance plan, there are millions of homeowners that didn't request one, right? And now it gets harder and harder to go in there and request one. as you get further and further behind on your payments. So one thing I like to tell people whenever we're doing industry updates or whenever we're saying, just don't get drunk on the headlines, right? You got to get beyond the headlines. Well, I found this pretty interesting. This was yesterday in Bloomberg, his News and Economics front page. How's this for a headline contradiction there, Kevin? On one hand, we have FHA mortgage delinquencies hit a record high with the economy rattles. And on the other hand, home builder optimism is the highest it's been in 22 years.
Well, that to me is an oxymoron, or the old enigma situation, because it's a seesaw. How can we have continued delinquencies on one end of the spectrum, but then the home buyers are optimistic, where they're the most optimistic since the late 90s? My question is right now, number one, home builders, what price points are you building in, and who are your buyers? And then number two, if you're building affordable houses, you're typically going to be selling to FHA clients. If Ginnie Mae, so FHA and VA, is in trouble because of increased delinquencies and everything else, they're going to be losing money. Their loans are going to be more expensive to first-time homebuyers. And we've also seen, Bob, we've seen the trends where the underwriting criteria for FHA and VA has changed dramatically over the past 45 to 60 days. So yeah, I kind of look at that and I just go, yeah, I'll look to the left, look to the right, but at the end of the day, I'm going to ignore it.
Yeah, and we will drill down a little bit as far as those underwriting overlays and how they've tightened up a little bit when we get to the state of the residential housing market here in a little bit. But I wanted to talk a little deeper on the FHA delinquency, because as you mentioned, a lot of these are first-time home buyers, and they're buying the we'll refer to the lower end of the value spectrum, as even though the average first-time home buyer now is probably over $200,000 loan, but the FHA delinquency for the second quarter is just a tick under 16%, 1.6. That's up from 9.7 in the first quarter of the year. Okay, so that it hadn't quite doubled, but that's like a 70% increase in a 3-month period. And that 16% delinquency, that is the highest, according to the MBA, since 1979. And just to put all that in perspective, 1979, that's the year I graduated from high school. So that ought to tell you how long ago that was.
Bob, did you have a polyester pantsuit for graduation? Because I'm thinking it had to be polyester if it was 1979.
Kevin, it was a leisure suit, not a pantsuit. I mean, let's get it right.
All right, I'm just checking, just checking. And so
Saturday Night Fever every day.
I liked it. So, and Bob, just one more point, because guys, we're not trying to make this a wonk fest. We're trying to give you real numbers, because we track all the data. We track a multitude of data points, always trying to sort out noise from reality. But Bob, to your point about the FHA and the FHA home buyer, I took statistics from one of the most, I'm going to call it the hottest MSAs in the United States in terms of home buyer activity and price increases, and that's Columbus, Ohio. And I broke down, I was able to look at how many loans are going FHA, what the average loan amount was, which ironically was 226, and then the credit score of that FHA borrower, but then also how much money they were putting down. And again, with FHA, it's low down. It's either 3.5% or 10%, and the majority of loans were all 3.5%. So these are borrowers who they've qualified for FHA, but in terms of being able to recover from a delinquency or weather some severe economic impacts, probably the least able to do so.
Yep, and one final point before we move on, back on that FHA, as I said, the overall delinquency, again, we look at trends, and whenever they're talking about these numbers, these are national numbers. So the national number is just under 16%, but just to kind of give you a perspective, The highest delinquency already is in New Jersey at over 20%, followed by Nevada, New York, Florida, and Hawaii. So those are where the pockets of the delinquency that are driving the numbers up. And the overall delinquency, not just the FHA, but the overall delinquency in the GSE book right now is 8.22%. So keep your eye on those numbers there, because a lot of rumors and a lot of people are wondering, does that mean that we have a foreclosure tsunami coming down? And I'm going to get your opinion on that, Kevin, but I want to kind of compare it first to what was happening in 07, 08. And we all know that at that time, there was truly a tsunami of foreclosures over an extended period of time. But one of the causes of that is what they refer to as a dual trigger, meaning two things have to happen if you're going to have a flood, so to speak, of foreclosures. And the first one is obviously what we've been talking about here for the last few minutes, and that is the economic hardships that borrowers encounter, whether that's unemployment, whether that's an illness, whatever that may be. But the other issue that causes a flood of foreclosures is when the properties are underwater, meaning they have a lack of equity in the properties. That is not the case right now. I mean, the housing market is a much stronger position, as we're going to talk about, than it was obviously back in 07, 08, when that equity position, what little they had, was squeezed right away, and millions upon millions of borrowers became underwater. Right now, a lot of borrowers have the ability to tap into that equity, whether they're going to sell their property or refinance their property in order to continue to, provide the home and make their payments and so forth. So it may have a larger impact on renters, and we can talk about that as well as we get into a little bit of the foreclosure and eviction moratoriums. But right now, if I had to guess, Kevin, I don't see, at least in the short term, and short term being through the end of 2020, I don't see a huge amount of foreclosures hitting the market, or even not necessarily hitting the market, but even getting teed up to hit the market. What are your thoughts on that?
Well, I completely agree with what you're saying. If you take this out and build a timeline on it, I don't see the first trickle coming until probably mid 2021, but then it's going to be kind of, that whole, you see the trickle going over the dam, next thing you know, the dam kind of breaks, and you're going to see an increase. And the reason that I believe that to be true is, number one, Bob, you're exactly right. The equity position for the average homeowner at this point that's going into a distressed situation is different. They do have some more protective equity, because unlike what happened, 2004 through 2008, where everybody kept refinancing and stripping equity out, we don't have that scenario anymore. That being said, you still have borrowers that, even though they've got equity in the house, they may not have the financial resources to pull themselves out of the hole. And that's going to be caused by, number one, either losing a job or losing income from their job because it's economic conditions, or they've lived through, they've burned through their savings because they don't have a tremendous stockpile of cash they can dig into. And then lastly, there is a calendar component to this, where because of the moratoriums, where they turn off the legal process and put it in the pause, then they're going to click it back on. Well, the backlog that we've got to work through is going to create delays in, and I'm just going to use the word due process. And so, for example, like just in Michigan right now, and I talk with an attorney who's in Lansing, and he checked with the bar association. They have 100,000 evictions basically sitting there on hold. So they've been filed, but there's nothing that can be done with them right now, because they're still slogging through the federal moratorium being lifted, but then there's a state hold back on it. And then once that happens, the courts, especially now with the COVID, can only process so many at a time. So I agree with you. I don't see anything happening right now through the end of the year. But I would say mid 2021, I think you're going to start seeing a pretty good shift.
Well, I'm going to make you look like you know exactly what you're talking about, because I mentioned at the top that I had some breaking news, and I just got this come across my feed here. And let me show you what just got. FHA and HUD has extended their foreclosure and eviction ban through the end of the year.
How, you slid that in on me. We worked together this morning as compadres, and then you slid that in after we hung up. Man, that hurt.
That literally came through, and I was like cutting slides. I was like, I got to post that on there, because a lot of the things we've been talking about, you're right. I mean, it's like, what are you going to process those evictions? Are you going to begin those foreclosures? Well, this whole delinquency bucket that we've just been talking about, the FHA piece, the first time home buyers, the people with the least amount of equity in their properties, they are now extending the foreclosure and eviction ban on folks. And Kevin, how does the FHA HUD eviction ban? We all know what the foreclosure moratorium means, but why do they say eviction and how that relates to FHA and HUD?
Well, the main reason is because of the rental component. So if you look at multifamily and you look at any multifamily that has the quote unquote federally related debt, and in particular anything that was financed through a HUD loan or an FHA loan, they're basically telling the operators of those properties, you've got a shelter in place. You cannot evict your tenants, and so that now tells us that we have at least another 120 days where these multifamily operators are going to be sitting here going, what am I supposed to do? You know, my rent collection's down, but I still got to pay my maintenance cost. I still got to pay property taxes. I still got to pay water bills, gas bills, whatever. What am I supposed to do? So again, this is, to me, this is going to add stress to the marketplace.
And I guess in one way, to your point there, that is going to make it similar to what happened in 2010 and on, when the local municipalities were facing serious issues from an income and revenue standpoint, because, you know, paying taxes and keeping those services in place. I mean, if you own an 8-unit building that's got FHA or HUD financing on it, and you're not getting your rent payments, and you can't evict the people, and you don't have the cash flow, you still have those water bills and garbage bills and taxes and those type things. I think we're going to see some strain there. And as a matter of fact, that's going to bring me to the next point, and that is the gridlock that's happening in Washington, D.C. One of the main tipping points on why an agreement to the next stimulus package has not been even close to agreed upon is the difference between how much money or how much additional money will be included to give to state and city governments. And the Republicans said, we gave you money already. They did change what they could use it for, but they're not bailing out states and cities that were already at a deficit. And the Democrats want $1 trillion on top of the rest of their package to go to state and local governments. So that is one of the things that, in my opinion, that's way too big a hurdle to overcome anytime soon. I mean, I don't see how they're going to be able to overcome that.
Well, and Bob, you and I made a commitment to be politically agnostic or apolitical, if that's a word, when we went through this slide. And to me, gridlock is the perfect explanation of what we've got right now, because we went through the first round, and the first round was done very, very quickly, and they tried to go consumer direct. So to homeowners, renters, et cetera, they tried to get money into their pockets as quickly as possible. Then they brought in the business owners. Right now, the read I have on it is the stimulus package. They're trying to give more money back to the average consumer, but they're still not addressing some of the gaps on the business side. And also there's an argument about, wait a second, guys, if people can go out and work and there is no adverse health effects at this point, et cetera, and we see downward trends on everything, why should people be sitting at home collecting a check and not paying their rent and this, or making a mortgage payment? And then again, guys, I'm giving you as objective information as I can, and I'm trying to give you objective perspective. At the end of the day, the gridlock is going to continue because you have two diametrically opposed schools of thought on this thing. Meanwhile, there's everybody who's stuck in the middle. And in this case, it's going to be real estate investors, real estate operators, because we don't know if we can't evict anybody and we can't foreclose on anybody, but there's no money available to pay bills. At the end of the day, whose lap is this thing going to fall on?
Yeah, absolutely. And you kind of mentioned the unemployment and what's going on. I like to say the gridlock is between one group that can't do anything and the other group that won't do anything. And you kind of mentioned the unemployment benefits running out. Well, during the term of the CARES Act, which started, I guess in May, ran through July, the federal government was, they call it enhancing the state unemployment, $600 a week. That cost $250 billion to do that. So $250 billion was paid out during that period of time to help folks on unemployment. So just kind of a little fun breakdown here. 38.4 billion of that money went to residents in California. Now, obviously, California, if not the most populated state, is definitely one of the top 2 or 3. So not surprising there. And then on the flip side, just for all you folks listening, in South Dakota, only 177 million of that 250 billion went there. President Trump tried to come in with an executive order and say, okay, we'll do $400 a week. The federal government will do $300 if the states will make up an additional $100. There's been arguments on whether that's constitutional and so forth. Even if it happens, that's only going to cover another 6 weeks. All right, so I don't see any immediate agreement coming down the road, and that means I don't see any real solution there. And Kevin, I think that may lead to an increase in bankruptcies. I mean, like you talked about earlier, if somebody doesn't have the income or the motivation to return to work because of the previous unemployment benefits, they can't make their payment, then what are they going to do? Well, personal bankruptcies have increased each of the past 4 months. As a matter of fact, in July, there was 40,000 filings. That was 11% more than there were in April. And what we have to keep our eye on is the things that we've been talking about and possible solutions there. And that is the unemployment expired, the moratorium is being lifted. We just found out that those are going to be extended. So will that help and decrease the amount of bankruptcies? And as far as the mortgage forbearance plans winding down, well, more and more people are extending their forbearance plans. So what is your take on the personal bankruptcy side? Is that something that you see a spike coming?
Yeah, so I love the slide, and I'm going to tell you that what this is. This is an exercise in physics, and I know that sounds weird, but Newton said for every action there's an equal and opposite reaction, right? So with personal bankruptcies, that in this case we're going to assume it's mostly 7s and 13s. That's going to be the consumer who's typically a homeowner or a renter. Those are going up. I expect those to continue to rise, and I would love to in October see what the number is. And again, we're not trying to wish ill. We're just looking again at what the market momentum is. And then, Bob, the reason I say there's an action and an equal opposite reaction, where the eviction moratoriums are being lifted, because of the backlog, I think you're still going to see the bankruptcies on the rise, because you're going to have real estate investors who still control. So small individual investors still control over 88% of the rental market in the United States. And they're just going to run out of gas because their banks aren't giving them money. They typically aren't, they don't have $1 million buried in the backyard in a can. And they don't have a lot of resources to go get liquidity. So to me, I think personal bankruptcies are going to continue to rise. And then I also think that there's an argument to be made that there's going to be some small businesses that will be filing as well, which would be a different BK. Oh,
Well,
look at that. Huh,
it's almost like we practiced.
look at this.
So yeah, I mean, Chapter 11, year over year are up 52%. Okay, obviously May was when it was spiking, and that was right in the heart of the shelter in place, and right when some states started to reopen. But over 4,200 Chapter 11 BKs showing here, and I know you've got some information you want to share on some of the small businesses, but it's not just small businesses. I mean, I can tell you Brooks Brothers filed bankruptcy, California Pizza Kitchens filed bankruptcy, and Taylor's filed bankruptcy. So it's the whole slew of retail, hotel, some of the heaviest impacted parts of the economy. It's being reflected in some of these, which obviously rolls downhill to the employment numbers.
Oh, and Bob, you're dead on, because the Chapter 11 filings, this is a textbook example of cause and effect. And what I mean by that is, so Ann Taylor, Brooks Brothers, all the big names, that I think they're calling them like the flagship bankruptcies. Remember, everybody that was an employee to them is now going to be out of a job, either permanently or temporarily. All their suppliers, their vendors, et cetera, are all going to be impacted by this. It's just like there was a large BK filing by a hospitality operator, in this particular case, a restaurant operator, where they are closing over 5,000 of the restaurants they own, and these are flagged restaurants, Pizza Huts and Wendy's. And think about the amount of people that are employed in those restaurants and what's going to happen there. So as the 11s continue to increase, the 7s are going to exponentially increase as well.
Well, let's turn to a little bit of hopefully good news, or at least what we can keep our eye on to determine when the good news is coming. And I like to think of these 3 indicators that we could feel confident that a recovery is coming, and these are all based around the consumer, right? Consumer confidence is key. The consumer demand is key. That's the pent-up demand. People are ready when they're holding their money. When are they ready to spend it? So consumer spending. I think that is what's going to drive the recovery, in my mind, is really the consumer spending. And consumers are not going to spend until they're confident that the economy is turning around. And unfortunately, you can spend 10 minutes listening to the news or on the internet or reading the headlines that come across, and all you hear is depressing economic news, which I don't know that that's a complete story. As a matter of fact, you can take a look at this chart here. The consumer confidence, if you look on the bottom right, around May started spiking up, and it was pushing right back up. And then with the some of the hot spots across the country, like Arizona and even here in Texas and Florida, the confidence has dipped the second half of July and the first half of August. So we're right back to almost a low point where we were in April. So we have to keep our eye on what that means to the consumers. If the consumers aren't confident, they're not going to go out there and spend the money. If they're not spending the money, it's going to continue to be a drag on the economy. The Urban Institute came out with this, and they were talking about minority home ownership and how that impacts. And there was a whole detailed report, but I wanted to pull this slide out here because as we were talking about consumer confidence, it's great to have the consumer confidence to go out and spend money on, to boost the economy, whether that's shopping at Walmart or Amazon or whatever. But what is your confidence in making your mortgage payment or your rent payment? Well, this one shows right here, and the blue is no confidence at all, and the gold is slight confidence. And what is your confidence in to be able to make next month's mortgage payment? And you can kind of see the trends there. The one on the left is the total population, and then it goes white, black, and Hispanic from left to right. So, this just kind of gives you an idea, and not to, you can, if they broke it down in my mind as income brackets, to your point earlier about the employees as such retail and restaurants and stuff, those are the folks that are going to be impacted the most and be able to make their rent mortgage payments because, obviously they're that lower to middle income borrower or tenant.
Right. And this slide compared to the consumer sentiment slide, they almost contradict each other from one aspect. If you go and just go to the average Joe, on the street and go, are you going to go spend more money this year on Christmas? And the guy says yes, then the consumer sentiment goes up. If you ask them, are they going to spend more money on Christmas this year? They're going to go, no, then it goes down. So I look at the consumer sentiment as just, I don't put a lot of weight to it because I go and look at the real numbers, and you and I talked about this all week, where all the retail guys are reporting, and all the retail stuff, even though people have to do curbside delivery and the Amazon vans aren't back and forth, most of the retailers blew through the roof, and it was exactly the opposite of what Wall Street predicted was going to happen 4 months ago. Meanwhile, with the confidence ability in terms of who's going to make next month, or can you make next month's mortgage payment, one of the things that's not factored in here is how many people are going, I don't know if I can make it because I'm holding out. I don't know if I'm getting an extra $600 or if I got a check for $1,000 coming in the mail, or so they're kind of hesitating. So here, I'm going to take a skewed response to this one, and we'll find out, because again, this is more of they're trying to take a forward-looking prediction, but the only way to get the accurate answer is you got to use the actual or lag data. So we'll see.
Awesome. All right, well, that's going to wrap the update on where we are with the government assistance and the stimulus plan, and we're going to turn now and take a look at some opportunity. I know you read the book before.
Yeah.
Probably many times. And in the midst of chaos, Kevin, there is also opportunity. And I know you spend a lot of your time taking a look at some of the data as we see it come across on the residential housing market. I know you like the underwriting overlays. We're going to look at that. We've talked a lot extensively about the mortgage credit availability and how folks that could get a mortgage back in January cannot get a mortgage now. We're going to talk about what the typical borrower profile of people who are actually getting closed loans today. What does that look like? Give me a snapshot of that.
Yeah, that's our favorite question, right? What's happening today, and what do we need to do to adjust in our business to adjust to that market condition?
Right, and how is that going to present us with an opportunity? So we're going to look at the home values. What are the trends show there? Closing timelines and purchase and refinances. And when we talk about closing timelines, Kevin, I think we've got a term of the fractured closings, and we're going to drill down on that a little bit and go there. But first of all, let's talk. Most folks have probably seen this chart. It ticked up a little bit in July. That means that some of the credit underwriting is loosening? Is that a start? It looks like now still over 30% of the people that could get a loan in January cannot get a loan in July. And Kevin, I know you spend a lot of time looking at what we refer to as underwriting overlays. Why don't you kind of explain what that is before I get into what a borrower profile looks like?
Sure, sure. I'll jump into that. So as part of just being a recovering mortgage underwriter, mortgage company owner, et cetera, I still keep my hands in what the agencies, Fannie, Freddie, and Ginnie, are doing to residential underwriting. So we're going to call that conventional underwriting. And then also what I do is I look at what's happening in the world of non-owner underwriting. And the reason is because in the world of residential real estate, there's two buyers. There's an owner occupant and there's an investor. Right now, the owner occupant, they keep getting squeezed. The mortgage, I'm going to call it the mortgage products that are available to them, continue to get squeezed. Bob, your point about, there was a little bit of an uptick on availability. Well, I did some homework on that, and I reached out to some lenders that they specialize in jumbos, and then I also talked to a couple lenders that work the full spectrum, so first-time home buyer all the way up, and every one of them said the same thing. They said there's a few more options available again, where 30 days ago there may have been no jumbos. Now they're going, the jumbo is back to a certain extent. About 50% of the lenders are back in, but they've all cut their LTVs by 5, 10, or 15%. And then they've increased their reserve requirements by 5 or 10 or 15%. So all they've done is say, hey, we've got the product, it's available, but they've actually narrowed the amount of people that could qualify for it. And the same thing is happening in the world of just conventional underwriting, where today they're going, yep, we still have first-time homebuyer programs available, but you have to have a credit score of blank. And if your credit score is within a certain threshold, it makes the loan more expensive. The two driving factors in mortgage underwriting is debt ratio and credit. That has never changed. And
so what you're saying is there's all kinds of programs available, but is anybody really going to get them?
No, the answer is right. I don't see that happening. Right.
All right. Well, let's take a look at that, right? Because everybody says, oh, we have rates below 3%, or you can get this or that. Well, that all sounds great, but the only way to really monitor it is to take a look at closed loans, right? What really happened? And I know you love this site. Didn't give it credit on it, but it came from Ellie Mae. And I mean, this is a profile of the borrowers on all loans that closed, and this goes all the way back to March of 2019. But on the left is the most recent data that are closed loans in July. Who's getting the loans, Kevin?
If you have a 750 credit score, you're getting a loan.
You also have to have what?
So hold on one second, because Bob, I gotta make it bigger so I can see the darn thing. So here's what we are right now. Here's what closed in July. 750 borrower. They had to have at least 25% down, and you had to have a debt ratio of 23 to 35. For everybody who it doesn't spend their lives trying to learn more acronyms like FICO, LTV, and DTI. DTI, that's your debt to income. That right there is probably the most restrictive debt to income ratio that we've seen in the past 7 years. That's back to 2011, 2012 standards.
So in your opinion, Kevin, which of these three profiles, credit, down payment, and debt to income, is the hardest for a typical homeowner to qualify for?
Right now, it's going to be the down payment and then the DTI.
So what happens to the people that got 750 credit but they don't have the down payment?
They're going to be looking for an alternative way to get a loan because they're ready, willing, and able. And what they're going to be looking for is somebody who will underwrite to a little different standard, might be a little bit more relaxed. And it's
So,
not, yeah.
in the words of our Sun Chu we looked at a minute ago, there's an opportunity here.
So, Bob, here's the reality. Every year, about 2.5 million people get turned down for a loan, either a purchase money mortgage or a refinance. The split is almost 50-50. So every year, about 1 million people cannot get a loan conventionally. And this is really where kind of the whole, they used to call it subprime, now it's called QM or alternative lending. That market is not going to go away. What I see is, instead of it being about 1 million people a year who are shut out of being able to buy a house, I see this year it's probably going to be, it could be as high as 1.5 million, just because they've got credit, but they're missing something. They're going to miss by a small percentage, and they're going to go, man, we're teed up. Can somebody give us a loan? And so, this is where one opportunity is.
So that's going to increase the pool of the penalty box buyers.
So Eddie came up with the term, and I hopefully he trademarked it. He came up with the penalty box buyer, and what that is if they don't fit in the conventional lending box, which is exactly what we're looking at, they have to go into a different box, and that's the penalty box. And so they may have a 749 FICO, they may have a back end debt ratio of 39, and they may only have 20% down. Tee them up that they're a good borrower. Just because right now the conventional guidelines say they're not, well, then there's a market opportunity, guys. Let's seize it.
So before we get into housing values and how they're trending, let's dig a little deeper. We're talking about closed loans, okay?
Mm-hmm.
And I don't have the percentage in front of me as far as what the pull-through rate is, as far as people that apply and the ones that close, but fractured closings,
right,
and the extended closing timelines. Speak to that a little bit and kind of talk through as some of these people that apply, get in the pipeline, but don't close, and how that's impacting the market.
Okay, so I'm going to give you a two-sided answer, but I'm only going to deliver it once. So right now, we know that the fallout rate for mortgages is about 29%. So that means almost 3 out of 10 loans is falling out. So they're getting turned down at the last minute. So if it's first transaction, think about that. For every 10 purchases that are teed up, almost 30% of them are may fall out just because of the mortgage underwriting. We also know right now that there are tremendous backlogs being created on the third-party vendor side, the appraisers, the title companies, et cetera, et cetera. I talked with 2 different title insurance companies, and both of them said the exact same thing. They go, right now, we have backlogs that are exceeding 21 business days, which to normal people, that means about a month to 6 weeks. And so closings are starting to get pushed back, and you've got a ripple effect where, Bob, you sell your house and then you went and put a new house under contract, and that's supposed to be all done right in a finite period of time within X number of days. If it's delayed on either end of that transaction, it could impact the entire thing. So right now, everybody that I talk to in the title side of the business said the backlogs are continuing to increase on a daily basis. I know one company, they basically shut down their commercial title side of their business to move everybody over to the residential side because of the backlog. And then on the appraisal side, I reached out to a gentleman in Chicago who is one of the lead attorneys for the appraisal industry. And he says at this point, the guys are just, they're exploding. And part of the reason for that is as the guidelines tighten up, Fannie and Freddie are getting away from doing appraisal waivers, and they want eyes on again, where they actually want real appraisals done with real comps. And the only way to do that is you got to have a real person do that and visit the property and be able to work the local market. So again, I see this creating additional stress on the purchase side of the business.
Yeah, I saw an article yesterday as well on FHA and how they put credit overlays on the underwriting of self-employed borrowers, even stricter on those.
Well, and yep,
You
and that's a great point.
be in the middle of the process, and all of a sudden here comes new credit overlays, and that's going to kick you out of the that's the fractured closing, right? That's the one you're ready to go, and for some reason it doesn't happen.
Well, and to your point with the overlays, which guys, it's in layman's terms, it just means extra requirements. Right now, the overlays are focused on the employment, in particular employment business owners. It's also on credit, where they're repricing loans. So in layman's terms, they're changing the terms at the last minute on loans because of credit, and then also on the down payments and the reserves. And one of the biggest impacts we see is FHA, as the lenders have raised their credit score requirements on FHA, it's knocked a lot of FHA buyers out of the 3.5% down payment bucket, and it's put them into the 10% bucket. So, and unfortunately, with a lot of those FHA buyers that are getting knocked out of the 3.5% bucket, in terms of them having another option, the only other option they may have is a 5% conventional, but they don't, the majority of them don't have a credit score to qualify for that. So guys, they're locked out of the market again.
Yeah, they were in the 3.5% bucket for a reason, right?
Right.
I mean, so,
Right.
all right, well, let's shift a little bit and let's talk about how this may impact where the home prices are headed. This is pretty interesting chart here. And Kevin, I know we have one coming up about medium sales price we'll get to in a minute here. But this is just kind of talking about the bar on the left, the darker blue is year-over-year growth.
Right.
And the lighter blue is month over month. And it's interesting because this is as of June, and you can see May and June, but then we're forecasting out 12-month period to the middle of next year. And the forecast is, for everybody who can see that chart there, there's that's a negative forecast. They think home prices are going to stay flat or decrease. Is that what you're kind of seeing across the country?
I am seeing price deceleration across the United States. Now, there are some micro markets where right now, just based on a constriction inventory, we've seen some spikes. But if you really look at what's been happening, the median sales price on existing homes has actually been dropping. We had two quick spikes, but I don't think that's going to be sustainable. I think it's going to go ahead and decrease. And one of the things I did, Bob, so you and I, as we were doing this, we wanted to make sure that we were putting together the best information. I went to the Fed. In particular, I went to the St. Louis Fed, which they track the median sales prices for houses sold throughout the United States. And it was very interesting where, so in Q2 of 2020, median home price was 313, so 313,000, and it's up a little bit, and NAR and everybody else is going, wahoo, it's all up. But actually, in Q1 of 2020, it was 329, so that was pre-COVID. And if you go all the way back to 2018, it was 330,000. So I don't see existing home prices. I don't see the uptick in pricing holding. Now, that being said, you're going to see some price increases on the new build side, but that's just going to be euphoria. And it's also a situation where if you look at the portion of houses that are sold during a year, new home sales is only a small portion of overall. So yeah, I don't believe pricing is going to continue to go up.
Well, on a side note, one thing I got out of this chart, in addition to what you're talking about in the upper right-hand corner, is it dates all the way back to the early 60s. So this is pretty
Yes.
much my lifetime right here, all on a graph. And it can say when I was born, the average price was about 20 grand. And we can see where we are now. So that was some pretty interesting data there. And obviously, since about 2005, that number has been from just under 240 all the way up to where we are now. So I agree. There may be some flattening of it, but I don't see it returning in any kind of a V shape going from that there. We were sorting some data, and we wanted to talk a little bit about some of the trends in listings and actual sales, because again, a lot of times you only hear the headline piece of it. So what are we looking at here?
So what we're looking at here is, I had just went to Redfin. They have a very good data center. And what I wanted to show was as accurate of a snapshot as I could with, all right, what's happening year over year and what's happening month over month. And everybody keeps talking about pricing hysteria and how, it's a great time to sell and it's a seller's market. Well, guys, inventory controls pricing to a certain extent. And at this point, in June of 2020, there was over 31% fewer existing homes for sale. Okay. To me, that's something to pay attention to, because that's a trend. And I believe that trend is going to continue. And, Bob, you and I had talked through that also. And all right, how does that impact, or how does that correlate to new listings? The only way you can increase the number of homes for sale, and the only way you can have existing home sales, is you got to have new listings. If you look, new listings are trending downward. And this is where I also am a believer that we need to factor in that with the low interest rates, there may be fewer and fewer people listing their houses.
Maybe that's why the home builders are so enthusiastic.
Well, they are, because they may be going, holy smokes, we're going to have buyers coming to us a certain bracket. We're going to have some buyers coming to us because there just isn't there's no existing home stock for them. So they're going to have to take what they can get. And that's going to be new homes.
Yep. And then, like we talked about earlier, trying to determine which bracket in the home value that you're going to construct, right? I mean, everybody says new first-time home buyers or lower end properties, there's not enough of, and we just talked about in depth how hard it is for some of those folks to qualify on that end of the credit spectrum. So there is going to be a dilemma, because I agree, it's going to be tough to increase the numbers of home for sales if all you're relying on are people listing their existing homes. I mean, just, in a personal situation, here in the Dallas-Fort Worth market, I'm what they refer to as an empty nester. Lived in my house for 23 years. It's probably way bigger than what Angie and I need. But just based on market conditions, we can't downsize we surely can't downsize for any savings in home value prices, because of the appreciation we've earned over the last 23 years. It costs us just as much to shrink our home and go from there. So why am I going to put my existing home that's almost paid for up on the market and go out there and look for a new home for sale? So, that's just kind of the trend you're going to see. And I read a lot of data on the millennial home buyers, because I've got two millennials myself, and they're both renters, and one lives in Washington, D.C., and one lives in downtown Dallas. So I don't have to tell you, they don't live in the cheap rent districts. It cost a lot of money just for housing in those particular markets. So I don't see the millennials, because I just don't think historically millennials have done a very good job, to your point earlier, of saving money and to be able to come up with a 25% down payment, unless mom and dad are helping them or something. I just don't see how they're going to enter the home ownership market. You got any thoughts on that before we move to the purchases and refis?
Absolutely. So Bob, what you've done is by telling kind of your personal story, you are bringing to light kind of a market hypothesis that Eddie and I worked on about 5 years ago, which was the old traditional real estate market of everybody having somewhere between 4 to 7 houses in their lifetime. That has kind of shifted a little bit. And here's the reason why. The economy is now different. So with you've been in your house 23 years. Right now, you've got all that equity sitting in your house, and you and Andrew are sitting there going, "Oh my goodness, you know, we're millionaires on paper in terms of what we bought the house for and what we could sell it for." But then you've got nowhere to go, right? Where you're like, "Well, wait a second. If I could," and this isn't, you know, your personal case, but let's just say 23 years ago you bought that house for, say, 220. Right now you could sell it for in the high fives. For you to downsize to a sub 2,000 square foot house to be where you want to be, you're at 550 to 600,000. You're like, why the hell am I doing that? I've got to spend all my money to go in a Cracker Jack box.
Absolutely.
So you're right, you're staying put. Normally, it used to be in the 60s, 70s, 80s into the early 90s. You'd still have 2 more houses to buy yet at your youngest age. And then let's see, your daughter is in the DC market, correct? And then your son's in Dallas, right?
Right.
So, all right, you have 2 kids that are millennials. Millennials are anybody that was born between 88 and 99. Right now, the median home price for an existing home in the DC, Virginia metro, my guess is probably, and I haven't looked it up, my guess is probably about 460. If your daughter had to come up with a 25% down payment right now, how close could she get? And then,
she'd probably be off by about 23%.
yeah, and then if you factor in her student loans and everything else, could she meet the back end debt ratio on this stuff? So now she's out of the market. And if you look at how long it takes the average person to save money, I mean, we did a thing for a water cooler Wednesday where in some of the markets right now, it could take as long as 15 years for somebody to save up for a 20% down payment. So that's going to take another layer of buyers out of the market. So I think it's getting chopped at the top, it's getting chopped at the bottom. And then lastly, if you look at the number of refinances that are being done, and then how many of them are actually a cash out refinance, the number is inordinately skewed, meaning instead of people pulling money out right now to tap into equity, most of them are doing rate and term refinances.
Yep. And again, perfect segue to what I wanted to cover here as we wrap up the state of the residential housing market, and that is the purchase versus refinances. And as I mentioned earlier, a lot of people get drunk on headlines, and all you hear about is historically low interest rates. Get it while you can, somewhere below 3%. And, you know, to the point we were just talking about, it's like, okay, so Angie and we're not going to move, but, you know, maybe we want to tap into some of the equity we have here. So maybe we want to refi. Everything we read or hear on TV is, hey, now's the best time to refi. We got historic low rates. Well, I'm going to have to kind of tap the brakes on that a little bit. And here's why. If you look at this chart here, the blue line is refi, the gold line is purchase. Okay, the spread between refi and purchase is at an all, I mean, it's never been this big. And 25 basis points, you know, it's just 25 basis points. That can make a huge difference, right? Not only on the amount of money you can take out, but on your, you know, your housing expense. I mean, you look back, this goes back all the way to the beginning of the year. a lot of the times the lines are right on top of each other. There was hardly any difference between a refi and a purchase as far as the rate is concerned. Well, right now, the average advertised rate according to Bankrate is 3.14 and the refinance is 3.39. But Kevin, it gets even better because I know you've been reading about this and I bet you might have had something to do with the name. Starting September 1st, Fannie and Freddie are coming out with what they refer to as an adverse market fee. 50 basis points on refis due to, and I know you're going to find this, odd, economic uncertainty.
So, Bob, I got out my oxymoron dictionary and I looked up adverse market fee because all we keep hearing is rates are at historic low levels. There's never been a better time, never, 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 never. And on August 12th, Fannie and Freddie snuck this thing in literally at midnight. And nobody even noticed it until the close of the business day on the 13th. And all of a sudden, everybody's screaming. I'm like, how the heck could you guys pop that 50 basis point bump in? And again, for people, to put it in lay terms, 50 basis points is a 0.5%, meaning if you go, all right, I'm going to charge them 1%, all right, increase it by 50 basis point, you're going to charge them a 1.5. Why is the adverse market fee going to be a negative impact to the refinancing market? Because you take Bob's 25-point premium and then the 50-point premium, you add that up, that would take a base rate from say 2% to 2.75. Lenders they're not going to take that punch in the mouth, guys. They're going to pass it on to consumers. And the only way they can pass it on is they've either got to charge you more origination, or to anybody who's ever been a mortgage lender on this call, discount, or they're going to have to just charge you a higher interest rate. So instead of the magical, mystical 2.5 30-year fixed, I see rates in terms of 30-year, 25-year, 20. I see them going back up into the fours, maybe 4.25 here within the next 6 months. The lenders aren't going to price it in. They're going to have to pass it on.
I agree. All right. One thing I wanted to cover before we wrap up is I wanted to take a look. We spent a lot of time focusing on the residential market, both owner-occupied and non-owner-occupied. But we've both been in this business a long time, and we're always looking for whatever opportunities are coming down the road, right? We don't try to live in the past. We try to see where things are going and how we can stay ahead of it. And I wanted to look at the commercial real estate market because I feel like there could be some opportunities there. Now, a lot of the opportunities that I see coming are going to be, on hedge fund, REIT type transactions. But I do think there's going to be a play there for some of these smaller investors, passive investors, some of the smaller capital funds like our own. So I want to take a look at the CMBS, commercial mortgage-backed securities, some of their delinquency data. I want to take a look at the multifamily, especially the Class C. I'm just going to call it a train wreck's coming. We've talked a lot about some of the impact of vacancies and also the repurposing of space or the reduction of commercial footprint. So I think there's going to be some real interesting data here. And I wanted to start off with, this shouldn't surprise anybody, right? I mean, all you have to know is kind of what has been COVID-19's impact on the economy. And obviously, hotel and travel has been decimated, and it leaves 16.64% delinquency. And then, as we've been talking about, retail. I mean, there are some great success stories when you talk about Walmart, Amazon, Home Depot. But for the most part, a lot of retailers, as we'll talk about here in a minute, have just been hammered. And you know, obviously restaurants fall into this retail bucket as well. So they're just over 11.5% are delinquent. That means inside of those mortgage-backed securities, there's this type delinquency coming up. And Kevin, I find it odd, or not necessarily odd, but a little telling here that at the very bottom, second to the bottom, less than 1% delinquency factor in the multifamily. Okay, well, multifamily consists of A, B, and C type properties, and for the most part, A and B are holding their own. Okay, but I think if we drill down and look at what Class C apartments, and why don't just real quick, give us a difference between A, B, and C. When I say Class C apartments, what am I referring to?
So with Class C apartments, what you're looking at, this represents apartments, multifamily, that really are the oldest, and by age, and also by design, and then also by location, where in a lot of markets, it's the least desirable for high scale, large scale apartment operators to own. They would prefer to be in the B to A space. But in the C space, this is where all your value add, your smaller investors, I'll use the word mom and pop, where they're like, you know, I've always wanted to own a 60-unit apartment building, and I can do that, but I've got to be in the C space. And again, they're the most expensive typically to maintain. Your rents are going to be lower than what you see in the B and the A, and they're going to be much more sensitive to any kind of hiccup in the economy, because again, the tenants, the renters that are living in those properties, they are typically working jobs that are hourly or lower salary jobs, and are more vulnerable to the same thing, any hiccup in the economy. And here's a pass through. If the tenants can't pay, the landlords can't pay their lenders, they can't pay their taxes, their municipal stuff, and so they're on weaker footing, so higher risk of default.
So if you're going to be synonymous with affordable housing, you're going to look at Class C. And just to put it in perspective, statistics show that 35% of multifamily fall under the Class C apartment. All right, and most of them are owned by mom and pop type landlords. Okay,
right.
Well, the dark blue on the left of each one of these brackets, A, B, and C, is the first quarter. So that's January through March. Then you got April, May, June, and July. Well, if you go all the way to C, the percentage of people who paid their rent in the first 15 days of the month for Class C last month was only 24%. Okay, that's down from 55%. Now, that doesn't mean they didn't pay the rent at all. This is just apartment trackers. They track who pays in the first half of the month to kind of give them an indication, as do mortgage loans, right? We know that the majority of the loans we own are due on the first of the month. So if we don't have it by the 15th, we know we may have a recency delinquency problem, so we keep an eye on that. But that compares to 45% in Class A. So that's a huge gap right there. So I think there's a train wreck coming. All the things we talked about at the top, as far as the government assistance and how this may or may not impact the middle to low income borrower or tenant, it's going to fall right here, and it's going to be the people with little equity in the home, if they're a homeowner, with the people that are renting Class C type properties. And that could be a Class C single family resident as well. Again, we look at national trends. One thing I always like to take a look at is certain areas of the country and how that impacts. I always like to pick on California. You know, California and Texas, we both kind of think we're our own country. This is Class C. Kevin, I know this isn't going to take any real math skills. So just looking at this chart, would you rather own a Class C property in California or in Texas?
Bob, I could be colorblind and still make this choice, and the answer would still be Texas.
Yeah, just to give you a picture there, 24% of Class C properties in California paid their rent in the first 15 days, and 85% in Texas. So talk about a difference in the two markets currently. you got to take a look at the ability here in Texas.
We're only
Evan,
seeing them from
let's
slides.
talk. We looked at this chart earlier, and I know you had some really good insight here. And this is how people have become over leveraged in their taking out money. Well, kind of talk through this is how people cashed out and use their commercial real estate property as kind of like their bank in order to, back in 06, 07, 08, people were tapping into their home equity and they were taking money out and mortgage to the hilt. Looks like that's what's happening now in the commercial space.
So this, when you had pulled this slide up when we did our talk through and we're putting our research together, and I love this slide because this slide gives you a perfect illustration of how commercial real estate can be leveraged not by cash flow, but by cap rates. And so one of the things you and I talked about was if you look at kind of the breakdown years, year 2010 compared to year 2017 and everything, with multifamily in particular, multifamily operators will always strategically refinance so that they can pull more money out of the project to then leverage that into something else or to take the profit off the table and run. And if right now, if you look at the kind of now the slide from 2019 to where we are right now, basically what that means is in about 2017, that's when the multifamily, the ability to leverage it to, I'll use the word the hilt, that's when it capped. So we are now at 36 months into a trend of, you know what, we maxed your market value. Now, market value, I'm not saying cash flow, we maxed your market value, pull out as much money as you can, and then you either, hunker down or you sell the properties off. And especially in the world of multifamily, you could go ahead, refinance, and then you can take that property and then sell it off with the financing in place. So particularly in the A's and the B's, not as much in the C's. So this is definitely a case of leveraging, and it was leveraged to market conditions and caps.
And there are going to be a lot of folks that are going to owe more than they can liquidate it for.
Absolutely. And Bob, you, Eddie, myself, and we've got some very, very experienced mortgage lenders in the commercial space that we all talk to and work with on a daily basis. And we all understand that there are people that they go, well, it's trading at a multiple, meaning, it's trading at 85,000 a door. Well, it's trading at 85,000 a door based on a cap rate. Well, if they change the cap rate, that same door could in a span of 12, 24, 36 months, go from being worth 84 a door back to say 60 a door or 45 a door. And that doesn't mean the rent has actually changed that much. That's just what the market thinks the thing is now worth. So there's going to be a lot of operators with their pants around their ankles.
Yeah, keep your thought here because we're going to talk about that here in just a minute. But you and I were also looking at a case study on a delinquent office building in Chicago.
Right.
That they had one tenant took up 75% of their building. It's a $29.95 million loan. They haven't paid their rent since March. So think about the drag on that. The banks know what's coming. Okay, here's the big four: Wells, Citi, B of A, and Chase. It's not just the commercial loans that we've been talking about. They have credit card debt, consumer debt, residential mortgage debt. That little stack on the left there, that's the money they put in loan loss reserves in Q4 2019. They have been ramping up, Kevin, the first half of this year. You take a look on the far right, the light blue is JP Morgan Chase. They put over 16.6 billion in loan loss reserves the first half of the year. and Wells City and B of A are not far behind.
Right. They're not moving little amounts of real money. And guys, remember, this is not accounting. This is actually having to move real cash from one side of the business to the other. They're not moving little bits of money. They're moving large cash positions because they know they're going to get punched in the mouth. And Bob, what do you think? You want to say September, October, there's going to be another ramp up on this?
Oh yeah, and this is the first step. The next step is the charging down of assets. And when they start charging down the assets on their books, that's when the NPLs start hitting the market. And this is the tip of the iceberg, so to speak, or the beginning of the waterfall. And that's what you're going to see. And this is what's impact some of the commercial real estate values. And there's Moody's, who does a lot of the ratings for the CMBSs that come out there. Here's their forecast based on everything you talked about a minute ago as far as cap rates and net operating income. And I missed this point earlier, but when we were talking about the delinquency data, when they were summarizing why the delinquency spiked, and this is a direct quote, and then you've probably never heard anything like this before, but they credit this is a direct function of aggressive underwriting. That is what caused the increase in value like that. Can you imagine that the actual net income is short of what the underwritten, overstated income was? So imagine that.
Well, I had given you my initial reaction and the comment that I wanted to use on this presentation, but I'm going to reserve that to myself and just say that I don't believe that it was aggressive underwriting, and that, you know, they're making the operators the bad actors. This is what the lender said you could do, and here we are.
Well, Moody's is projecting office buildings to decrease in value by the end of the year 17%, retail properties by 19%, and again, the hard hit hotel and lodging by over 20%. So again, it's all based on that cap rate that you just walked us through. And you know, there's going to be, that's where some of the charge downs on some of the bank balance sheets, and not only the banks, but some of the REITs and some of the hedge funds and some of the CMBSs. There's going to be some opportunities. A lot of them are going to be for the big boys. I don't think we're going to go put something together for that $29.95 million deal in Chicago, but there'll be some folks that are going to take advantage of that. I found this interesting. This is just a little tidbit on all the various factors that can impact your NOI, your net operating income. Kevin, you know what that's a picture of?
I'm going to guess it's the Empire State Building, Bob.
Well, to be more specific, that is the observation deck of the Empire State Building. Okay, the Empire State Building obviously has multiple tenants. So several of them have multi-floors in the building. There are a lot of small anchor tenants down on the bottom as well. But did you realize that last year in the second quarter, just the income tourists pay to go up on the observation deck, okay? Now they even have a roller coaster inside that thing, okay? I've been up there, but you have pay to go up there, all right? Last year, second quarter, just the second quarter, they earned $32.9 million in income just for letting people go look around New York City. This year, I don't have to tell everybody what happened in Q2 of New York. It's a ghost town. Now, this is not a typo, Kevin. This year, second quarter, $86,000.
Ouch.
Yeah, I mean, I don't even know if you get a calculator out to try to figure out how much of a decrease that was. I don't even know, especially based in New York City, if that would cover one employee working there, full compensation. Benefits.
It wouldn't cover the doorman. I know that.
So, I mean, that just tells you. And there's going to be some repositioning. And we talked about it earlier about, you know, people reducing their footprint in commercial space and so forth. And there will be some people that take advantage of it. And one person that already has in my mind is this guy right here. This is Jeff Bezos, owner, founder, Amazon. This was the old Lord and Taylor retail flagship. WeWorks bought it about a year and a half ago, I think, for $850 million. Well, Bezos just recently bought it from them for a little over $1 billion. And he's going to use 630,000 square feet, and he's going to have some corporate jobs there. So he is realizing, real quick, and again, stay politically correct, but let's walk through that story you and I talked about. Is when Amazon was looking for their second headquarters, and they had
Right.
okay, we're going to do DC and we're going to do Long Island.
Right, it'd be New York. Yep.
And all of a sudden, Long Island pushed back. Now, how is he taking advantage of that?
So this goes back to the whole look for the opportunity. And what had happened was Amazon wanted to put their second big headquarters in New York, and they were going to put it in Staten Island City. And what happened was they got pushback from the local government, the state government, and basically they learned that if you don't negotiate nicely with the right people, that public opinion will run you out of town on the rails. So they left, and they had committed. This was about a $10 billion project, and they didn't play nice with the right people. So now what's going to happen is Bezos is going to come into New York in the distressed market, and he'll end up doing everything that he wanted to do, where he was going to spend about 20 billion. He'll probably have it done. I think the number is 3 billion. I read that this morning. So he is taking advantage of market conditions where distressed pricing is often attractive pricing.
Yep. And that is what we want to make sure we do here, is we want to make sure that we learn and we see the opportunities. And we wanted to cover the residential housing market, the commercial real estate market, and the impact of the government and some of the programs that we have on there. Hopefully everybody's seen some opportunities. I want to leave you with this. My advice is to always be learning. That's why Kevin and I spend a lot of times reading reports and scraping data. On a side note, I've been in the middle of reading this book about Winston Churchill, which brought to mind, I want to close on this quote here, which I think is very appropriate for what we just covered. A pessimist sees the difficulty in every opportunity. An optimist sees the opportunity in every difficulty. Kevin, I appreciate you joining me today and going through this, and great job helping put the data together and talking through it. And I appreciate it. And thanks again.
Bob, thank you so much. It was a lot of fun. And again, I love going in and sorting the noise out of the real data and then giving everybody what the facts are as we know them today. And so again, Bob, thanks so much. I appreciate it. And guys, my takeaway on this whole thing is, remember, we're not trying to tell you that the wheels are coming off the wagon. What we're telling you is start preparing now, have your checkbook ready, but also don't go jumping in thinking that this is the only opportunity you're going to have. This is just going to have to play out because of the stress and kind of the reset that's going to happen in our business, in the real estate business, over the next 6 to 30 months. That's it.
All right. Thank you.
Well, I hope you enjoyed it. I hope you enjoyed the state of the industry with Bob Repass and Kevin Moore. Tons of experience there, right? Tons of experience. And really, really great information. I hope the websites and specifically the things they told you about the market will be things that you can continue to watch. If you have any questions for us, we'd love hearing from you. So right here in the band below is just going to say contact us. Just email us, info@noteschool.com. Do that. We'd love to hear from you. Any more questions or anything that would be helpful to you, or maybe learning more about what we do? Whatever that might look like, we always like hearing from you. Hope you really enjoyed this. See you later. Bye-bye.